For John, $5 usually meant a coffee or a quick takeout meal. He's in his early 30s, working a regular 9 to 5, and like most people, his paycheck disappears fast. Vacations? Rare. Freedom? Feels far away. But what if that same $5 a day could start building him an income stream that eventually pays for his goal of seeing new countries and to live the kind of life most people only dream about? In this video, I'm going to break down exactly how dividend investing works, why starting now matters more than ever, the simple numbers you need to know, and the kind of portfolio I'd build today. We'll also cover the traps that can hold you back, and how small, consistent steps can snowball into real financial freedom over time. And in the end, I'll show you a real-life portfolio that we'll make and how that portfolio can potentially turn a $5 a day investment into an over $1.3 million portfolio paying over $8,000 in monthly dividend income. But first, let's set the stage. This year, the numbers tell a tough story. For people in their early 30s, the median income is about $58,500 a year, which is roughly $1,125 a week. On paper, it looks steady. But after rent, food, insurance, and student loans, most people are left with just a few $100s at the end of the month, if that. That's exactly where John finds himself. In his early 30s, he's earning right around the average for his age group. He works hard at his 9 to 5, rents a small apartment in the suburbs, and carries some student debt. By the time the bills are paid, there's not much left for the things he really wants. Meanwhile, his friends seem to be racing ahead. Some are buying houses, others are posting vacation photos from places he's only dreamed about visiting. For John, it feels like he's stuck in a loop. Work, pay bills, save a little, repeat. And the question keeps running through his mind. Is this really it? Work for 40 years? Save what I can and hope that Social Security covers the rest? That thought is what pushed him to start looking for another way. A strategy that wouldn't just help him get by, but could actually create extra income to fund the life he really wants. And that's when he discovered what dividends really are. John always thought the only way to make money in the stock market was to buy low and sell high. That's what most people assume. You buy a stock, wait for the price to climb, and then cash out. But dividends work differently. And once John learned how they actually worked, it changed the way he saw investing. Here's the simple version. When a company makes a profit, it can share part of that profit with the people who own its stock. That payout is called a dividend. Some companies pay in cash, which lands right in your brokerage account. Others pay in extra shares, which means you automatically own more of the company without spending another dollar. And every now and then, if a company has a really strong year, they'll even send out a special one-time dividend as a bonus. The key idea is this. Dividends mean you get paid just for holding a stock. No selling, no timing the market. If the company stays profitable and committed to rewarding shareholders, you get income simply for owning it. For John, that was a total light bulb moment. He realized he could build a portfolio that pays him just like his job does, only this paycheck could eventually fund the things his salary never seemed to cover, like trips to all the countries that he dreams of. So understanding dividends is step one, but why start now, in this year? Well, this year offers a unique opportunity that makes dividend investing more powerful than ever. John wondered if he had already missed his chance. Stocks had been around forever, and some of his friends told him you had to start in your 20s to get ahead. But the truth is, this year is actually one of the best times for a beginner to step in. Here's why. First, inflation and higher living costs are eating away at savings. A basic savings account might pay 4% today, but that's temporary. Inflation often outpaces that, meaning your money loses buying power over time. Dividend-paying companies, on the other hand, often increase their payouts year after year, which helps them keep up with those rising costs. Second, technology has made investing easier than ever. In the past, you needed a broker and a lot of capital to get started. Today, you can buy fractional shares with just a single dollar. Commission-free platforms let anyone invest without worrying about fees. That means John doesn't need thousands in the bank. He can start with as little as $5 a day. Third, dividend-focused ETFs give beginners an easy way to diversify. Instead of betting on a single stock, you can buy one fund that holds dozens of stable companies, many with decades of dividend growth. It's a way to reduce risk while still getting exposure to cash flow. So when John asked himself, "Am I too late?" the answer was simple. No. The best time isn't 10 years ago, it's today. Starting small this year could be the first step toward building an income stream that pays for a new trip every single month. But how does a few dollars a day actually grow into something that big? That's where the snowball comes in. The real strength of dividend investing isn't just the payouts, it's what happens when you reinvest them. This is where the snowball effect comes in, and it's what turns small investments into life-changing wealth over time. And here's how it works. Suppose you invest $1,000 into a stock or ETF that pays a 4% dividend yield. At the end of the year, you'd earn $40 in dividends. Now you have a choice. Spend that $40 or reinvest it to buy more shares. If you reinvest, your $1,000 becomes $1,040 worth of stock. The next year, you earn dividends not just on the original $1,000, but on that extra $40 too. This means your payout is slightly bigger. Every time you reinvest, you're stacking more shares, and those shares generate more dividends, which buy even more shares. That is the snowball rolling downhill, getting bigger and faster as time goes on. A few $100s in dividends can turn into thousands, and thousands can snowball into tens of thousands. Now, let's bring it back to John. He's not investing thousands of dollars at once. He's setting aside $5 a day. That money buys him dividend-paying stocks and ETFs. Each year, those investments pay him dividends, and instead of cashing out, he reinvests them. In the end, I'll show you how this reinvestment decision plays out in a real-world portfolio and how it can turn a $5 daily contribution into a portfolio worth over $1.3 million, paying over $8,000 in monthly dividend income. But first, let me give you a beginner's toolkit. When John first started reading about dividend stocks, the numbers felt overwhelming. Dividend yield, payout ratios, growth rates, it all sounded too complicated. But in reality, there are only a few key metrics beginners need to focus on. The first is dividend yield. This is the percentage of a company's stock price that it pays back to shareholders every year. For example, if a stock is priced at $100 and pays $3 in dividends annually, the yield is 3%. It's a simple way to measure income potential. Next is the payout ratio. This tells you how much of the company's profit is being paid out as dividends. If it earns $1 per share and pays 70 cents in dividends, the payout ratio is 70%. Lower ratios often mean the dividend is more sustainable. If the ratio is too high, it could be a red flag that the company can't keep paying at that level. A good rule of thumb here is to look for companies with 70% or below payout ratio. Next comes dividend growth rate. Basically, how often and how much a company raises its payouts. If a business has been increasing its dividend year after year, that's a strong signal it values shareholders and plans to keep rewarding them. And finally, overall financial health. Companies with stable earnings and manageable debt are the ones most likely to keep dividends flowing even during rough patches. So John quickly realized that getting started was way simpler than he thought. He just needed to follow a few simple steps. The first step is to define your goal. Are you looking for a steady income now, or are you focused on long-term growth? John knew he wasn't after quick payouts. His vision was bigger, retiring with a portfolio that could cover all his bills and pay for a new trip every single month. That long-term dream gave him the patience to start small and stick with it. Next, he had to choose a brokerage platform. This is just the app or website where you buy and hold your investments. Some of the most beginner-friendly options include Fidelity, Schwab, and Vanguard. The key is finding one that's low cost and reliable. Step 3 is to open your account. This part sounds intimidating, but it's no more complicated than signing up for a streaming service. You enter your details, pick the type of account you want, a standard brokerage account or something tax-advantaged like an IRA. and you're set. Step 4 is where it gets exciting, picking your first investments. You can start with a single dividend ETF like SCHD for instant diversification, or build a mix of individual dividend-paying stocks. This is something I'll show you in just a couple of minutes, step by step, so you know exactly how to do it. Step 5, and this is key, is to turn on DRIP, Dividend Reinvestment Plans. This feature automatically reinvests your dividends into more shares. For John, this was the most important part. It meant his portfolio kept compounding without him needing to log in and click buy every time. Finally, the most important step, start small and stay consistent. John wasn't investing thousands of dollars up front, he committed to $5 a day, about $150 a month, or $1,825 a year. Before John got too deep into investing, he learned there were a few traps that could sink his progress. And trust me, these are mistakes almost every beginner is tempted by. The first is chasing high yields. A stock paying 11% looks amazing, but it's usually a warning sign that the company is in trouble. The second is ignoring fundamentals. A big dividend means nothing if profits are falling and debt is piling up. The third is buying hype. When everyone is talking about a stock, chances are the price is already inflated. And the last is skipping diversification. Putting all your money into one stock is like betting everything on one flight. If it gets canceled, your whole trip is ruined. Once John understood the basics and the beginner's traps to avoid, the next question was obvious. What should I actually buy? There are thousands of stocks and funds to choose from, but you don't need a massive list to get started. A small, balanced portfolio can give you income, growth, and stability all at once. John started with Goldman Sachs, which offers a 1.99% dividend yield, dividend growth of 17.92% over the past decade, and annual share price appreciation of 15.94%. That gave him exposure to a financial powerhouse with consistent returns. Next, he added Bank of America, which pays a 2.14% dividend yield with 18.15% dividend growth and 12.78% annual appreciation. It gave him another solid financial stock in his mix. For broad diversification, John chose the Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD. This fund pays a 3.73% dividend yield, has grown its dividends by 10.77%, and its shares have appreciated 8.52% annually. That became John's foundation: reliable, steady, and stress-free. He also included United Health Group with a 2.63% yield, 17.29% dividend growth, and 10.51% appreciation. Healthcare is an industry that never slows down, so this added long-term strength. Finally, John picked Tractor Supply, a retail chain that sells farming and outdoor lifestyle products, and it's built a reputation for steady growth even in tough markets. It only yields 1.54%, but with 20.25% dividend growth and 13.39% appreciation, it showed him how smaller yields can still deliver big rewards over time. The next step is to calculate the portfolio's dividend yield. The easiest way is to take a simple average. Since John is putting the same amount into each of his 5 investments, it makes sense to just add up all the yields and divide by 5. So here's how it works. Goldman Sachs has a yield of 1.99%. Bank of America is 2.14%, SCHD is 3.75%, United Health is 2.63%, and Tractor Supply is 1.54%. First, we add them all together. 1.99 plus 2.14 plus 3.73 plus 2.63 plus 1.54 equals 12.03. Now, since there are 5 investments, we divide that total by 5, and 12.03 divided by 5 equals 2.41. That gives you the portfolio's average dividend yield, 2.41%. Simple as that. You can use the exact same process to calculate the portfolio's dividend growth rate and share price appreciation. For John's mix, that works out to 16.88% dividend growth and 12.23% appreciation, the numbers that make his retirement travel dream possible. With the portfolio set and the numbers in place, the next question is obvious. What does it all add up to? A 2.41% yield, 16.88% dividend growth, and 12.23% appreciation sound impressive on paper, but what do they actually mean for John's future? How far can his $5 a day habit really take him? And can this portfolio allow him to travel to a new country every month in retirement? Let's find out. If John invests just $5 a day into this portfolio, here's how it's projected to grow. After the first year, his contributions add up to about $1,825, and that's exactly what his portfolio is worth. But as the snowball effect kicks in, the projections start to get exciting. By year 10, steady contributions and reinvested dividends project his portfolio to be around $37,799. By year 20, his portfolio will be valued at $221,717. The dividends alone are adding thousands each year, and every reinvestment means more shares, which makes those payouts even bigger. Then comes the 30-year mark. Around that time, John's $5 a day grows into a portfolio valued at over $1.37 million. Out of that, about $497,101 comes from reinvested dividends, with another $824,561 from capital appreciation, a total value added of roughly $1.32 million. Of that value created, John only contributed about $54,750 of his own money over 30 years. The rest came from compounding, doing all of the heavy lifting. By this stage, his portfolio will be paying nearly $101,887 every year in dividends, about $8,491 a month. That's enough to cover his living expenses and still fund a trip to a new country every month in retirement. John could be flying to Paris in the spring, exploring Tokyo in the fall, or relaxing on the beaches of Greece, all without worrying about money. Want to know which 50-50 ETF combo has crushed the S&P 500 for 10 straight years? Click the video on the screen to find out.